Good morning from London, everyone, and welcome to the Sustainable Policy Institute panel discussion on leveraging data, technology, and innovation for sustainable finance. Technology is projected to play a critical role in scaling climate action and will help to overcome challenges in data gaps, risk modeling, and is ultimately key to ensuring market and investor confidence in sustainable products and projects, as I think we all know. So this panel discussion is in line with our launch of the summer 2024 edition of the Sustainable Policy Institute Journal, where we're looking at the latest trends in climate-related technology, as well as how data and innovation can be a transformative force in catalyzing green finance. And these are some of the things that we'll be touching upon in our panel discussion today. So I'm Emma McGarthy. I'm head of Office Sustainable Policy Institute, and I'm joined today by Patrick Hoffman, who is advisor at the BIS Innovation Hub for Bank for International Settlements, Jose Manuel Marquez, who is Director of Financial Innovation and Market Infrastructure Department at the Banca de España, Carl O'Farrell, who is ESG and Risk Analytics Solutions Lead at State Street, and Marcus Mogbach-Ingolt, who is Senior Lead Climate Economist at Denmark's National Bank. Just a couple of housekeeping things. If you have any questions for our panelists, please do put your question and your name into the chat box, and I will put the question to the panelists that way. So thank you everyone for joining me today. Really, really appreciate you taking the time. I think this is going to be a really interesting and very useful question. We'll start with just a couple of minutes of opening remarks from each of our panels before we go into our questions. So Patrick, I'm going to go to you first, just to open up from BIS's side some of the work that you're doing. And again, lovely to have you. Thank you for joining us today.
Yeah, thank you very much, and good morning, everybody. Thanks a lot for inviting me to this panel, Emma. As you've already said, my name is Patrick. I'm the Subtech, RegTech, and Green Finance lead at the Bank for International Settlements Innovation Hub Singapore Center. And at our center, we run a couple of projects in the green finance space, and Viridis, the one that will also be, like the major content of the piece that we will publish in the journal, is a project that we have just finalized. And in this project, we try to provide a platform, a tool to supervisors to become much more active when it comes to day-to-day banking supervision, which is like one of the main objectives that we have here when it comes to the green finance projects at our center. We strongly believe that in the past, day-to-day banking supervision was too reactive and supervisors had to ask the banks too often to get the information right. And what we want to create is a tool that enhances supervisors to be much more intrusive and challenging towards banks. So before joining the Innovation Hub in Singapore, I worked for Deutsche Bundesbank for more than 15 years in various positions, most recently as a head of section in banking supervision, where I was also in contact with a lot of banks and where sustainability was one of the major topics. And I also spent 3 years at the German Federal Foreign Office to work as a head of section at the German Embassy, also in Singapore. And I also worked as a consultant before joining Bundesbank. So thank you very much for having me here today. And I'm really looking forward to an interesting discussion. Thanks a lot, Emma.
Thanks so much, Patrick. Yeah, lots of things that we'll come into there. So thank you again. Jose, I'd like to go to you next, just for opening remarks from your side and about this on your side. Thank you.
Well, thanks, Emma, for inviting me. It's a pleasure to be here. Just let me tell you what is the role that we are playing with this kind of issue that is in the Bank of Spain as a central bank. Obviously, sustainable finance is one of the key topics and one of the main areas of interest. And comparing with 2015, when this debate began seriously, that is, this reached almost all the departments in the bank on all the areas, including supervision, including monetary policy, including financial stability, research, everyone. From the perspective of my responsibilities, basically we are looking at what could be the role of technology in overcoming part of the problems that we are facing, that we are having in obtaining basically more information, but also how to obtain the typical things that we need to obtain in order to make the supervision or to anticipates problems from financial stability, like having stress tests, modeling scenarios, and so on. Then the role that we play inside the bank is understanding what is the role of new technologies in changing and transforming the financial system. And obviously, this is one important area. This is the one area that is new for the banks. Banks are not usually dealing with the climate risk. It's a complex risk for them. They did not have enough data. It's a kind of data that is difficult, that is not standardized. Then they need to use the technology to overcome part of the problems that they are facing. On top of that, I chair a group together with the BIS Innovation Hub. There is also a network of central banks in order to outreach and to share all the initiatives in several use of the technology. And one of the areas is particularly this one. That is what is the role of technologies in improving green finance. And basically, this group of central banks share the main initiative from the BIS Innovation Hub, but also put some of the main issues that we would like to have more work on that and to share experience with other industries, like, for example, the insurance sector that is more used to deal with this kind of problems. Thanks a lot.
Thank you, Jose. Yeah, as you say, I think technology will play an integral role in supporting green finance, and we'll go into that. Marcus, I'll come to you next. If you could give slight introductory remarks from what Denmark's National Bank is doing in this space. Thank you so much. Pleasure.
Thanks so much, and thanks for the invitation here today, Emma. So I'll talk a bit about what we do as a central bank and also what we do as a government debt manager, because we're really both engaged in working with climate-related risks, but then also providing market confidence for our issuances of green government bonds on behalf of the Danish Treasury. And I think that really brings me to the first point I want to make, that it's important to distinguish between informational technologies, data, aimed at risk managing climate-related risks in financial markets, in the financial sector, and then on the other hand, other informational technologies, other data sets aimed at providing confidence in sustainable financial products. Because risk management of climate-related risks and investor confidence about sustainable products, that's really two quite different animals. But I think in reality, they are often conflated, but they are quite different. So that's some of the things I'll be talking about today.
Thank you. And I think that's actually quite a nice segue into Carl, who is our non-central banker on the panel. So thank you for representing the private sector, and no pressure. As Marcus said, I think it's very important to distinguish that, and this is one of the reasons why it's fantastic to have your perspective here to talk about how technology can help with investor confidence and sustainable products. But anyway, over to you for introductory remarks, and this is definitely something that we can go into a little bit later too. So thank you.
Yeah. So I'm Carl O'Farrell, as you mentioned earlier, leader of the analytics solutions for the TrueView Analytics platform in State Street. So coming at it from a pretty different angle from everyone else, we are providing, I suppose, a technological solution to asset managers and asset owners. For those kind of dual aspects, one being obviously the risk management side of things, which encompasses also regulatory reporting and the operational challenges that are there, but also for them to provide investor confidence on their side as well. So we work with a large number of vendors in the ESG space to bring that data in. And I mean, our view first and foremost is on that risk oversight. We are a risk oversight platform, and when it was determined where ESG should sit in our industry, in our company decided that it was the best place for it. Also because in terms of risk challenges, there's huge amounts of data involved there, and if anything, the ESG space in terms of data is even larger. So we'll certainly get into, I think, a few of those challenges and solutions later in the panel, but it's good to be here.
Lovely, thank you, Carl. So yeah, I'm going to jump straight in with my first question, and I think based on Marcus's point, we'll start on the risk element of things first, and then later on in the discussion, we'll go into the driving of how technology can help drive sustainable products and investment and issuance as well. As we've noted, we do have 3 policymakers on the call. So I think the first question that we can ask is how technological developments will support central banks and policymakers, and in particular, going into this risk element, how will the developments in technology help drive better risk understanding? So Marcus, maybe if you don't mind, I'll go to you first on this question.
Sure, thanks a lot. So I would really take a step back here because climate change and the green transition, they are new phenomena. That means that we don't have the data on the implied statistical distributions of climate change and of the green transition. We don't know the outcomes with certainty in the future. And that means we kind of have to come up with informational technologies, data, models to circumvent this. So what we're doing at the Danish Central Bank is that we are working with an expert group under the Danish Ministry of Finance on making climate scenarios for the Danish economy. So when I talk about climate scenarios here, then it's really transition scenarios. So it's scenarios for how the Danish economy is going to transition in the years to come, and how this is going to impact firms and both and banks also, and in particularly the lending and investor relationships between the financial sector and the firms. To make these technologies, we need some data, we need some information, and what something we're doing there, or not that we are doing, that this expert group is doing, is to collect technology catalogs based on forward-looking industry analysis. So it's catalogs with data about the abatement technologies that are perhaps not out working in the economy today, but that will be available for firms in the future to give an idea about the degree of carbon abatement at different carbon prices. So that's one example of how new data is being built, and models are being built to overcome this opaqueness of forward-looking or future climate-related risks.
No, that's really excellent, because one of the things that we hear all the time is obviously a climate risk is hard because you're having to kind of use backward-looking data, which are also lacking, but really what you need is that forward-looking understanding of what is going to happen in the future. So I think this is really really useful as a tool.
Yes, exactly. I could also just add here that, of course, this also applies for climate change. Like the example I gave, that was on the green transition, but we also need climate scientists to make better models with tipping points, and also with technological options for adjusting to climate change.
Yeah, no, thank you. Patrick, obviously, you've been working very closely on this within the BIS, on very innovative work. If I could pass to you next to also go into this question of how technological developments can support central banks, policymakers, and drive better risk understanding and analysis.
Yes, thanks a lot, Emma. No, I think I couldn't agree more with Marcus when he pointed out that for a better understanding of the risks that we are facing because of climate risk, we first of all need to better understand and work with the data that we have, and we also have to find out the data that we actually need to run this analysis around risk. So from my point of view, I think that central banks and financial authorities have a very important role to play in alleviating the implications of climate risk on the financial system, and also central banks need to carefully monitor and mitigate climate risk, and they also must make sure that they have the adequate and reliable data to do so. And because of this, we at the BIS Innovation Hub, we run a lot of collaboration projects with other central banks exactly on these topics, in particular when it comes to sustainability and green finance projects. So at the beginning, when our center was was founded 5 years ago, we started with a project where we created a modular platform to work on granular and unstructured data. This was very important for us because we somehow had to make sure that we put supervisors into a position to actually be able to work with granular and unstructured data, which was not so much the case before, or was at least in some central banks a problem. We then included climate data into this platform to make supervisors able and to enhance them in their work, to actually find out, working with data, what the real risks are and how to talk to central banks and how to talk to the supervised institutions from a central bank perspective and make sure that they actually know about the risk and steer the risk in the right way. We also run a project at the moment together with a network for greening the financial system, where we try to bridge the data gaps. Because what we see is that whenever we talk to central banks, one of the problems is that they all tell us, look, to really analyze risk, we would need data, and the data is not there, so we cannot do anything. And we are actually of the opinion that this is not true, because a supervisor does not necessarily have to be totally on the spot and has to really quantify a risk completely right. A supervisor only has to find out where potential risk could be. And therefore, we think that it's actually good enough to start with a roughly right approach with the data that we already have there. We just have to get started. And then our platforms and tools and technology will improve over time once we have the better data available. And I think the key lessons that we have learned around data is that it's extremely difficult to make people aware that a pragmatic approach is much more useful in this regard, and that we have to start and try to quantify and talk and start the discussions in banks when it comes to risk coming from climate risk.
Yeah. Do you have any use cases or examples of kind of how this has been effectively useful? And maybe I don't have to name any central bankers or policymakers, but anyone, examples of where this has been integrated and used and some of the successes.
I think actually that Project Viridis, the one that we feature in the journal, is a very good example, because we also run a collaboration community since a couple of years. And in this collaboration community, we regularly meet with 18 central banks. Every second month, we organize workshops and hackathons around the tools that we do and about the issues and problems that we see. And the information from Project Viridis, for example, is available in a central bank internal repository, so a GitHub environment. And the central banks, they can work with this tool. They take out and use the source code and put it into their own environment, and then fill it up with data from their regulatory reporting and add climate risk data, then to analyze the risk in their jurisdiction. So I think this shows like the analysis of risk could be transferred from the experimentation in the BIS Innovation Hub to an actually useful tool for the central banks.
Thank you. No, agreed. And as you mentioned, this will be featured in our journal. So if anyone wants more information on Project Viridis, then you can read the article which Patrick authored. So excellent. Jose, I'll come to you next from the Bank de España's perspective, touching upon how technology can support central bankers, maybe how it's supported Bank de España, and how technology and better data can support better risk modeling and better understanding. So over to you.
Yeah, okay, thanks. Let me first emphasize that all these challenges with risk is very common to many central banks. The initiatives like the one that Patrick was mentioned from the BIS Innovation Hub in order to create these public goods for central banks, doing some project where all the communities of central banks could use, are particularly welcome, because it's not only promote the use of these tools, but also harmonize how we are using these tools. But saying that, that is basically in the green finance we have. This is the common problem that we don't have enough data. We don't have standardized data. Part of this problem will be solved in the future when we have more standardization in the regulatory requirements, but we don't have time and we have to face some decisions right now. Then let me provide you some overview of what are the main areas that we identify that we can work with technology. That basically some of them are with obtaining more information or obtaining information, and others are with managing with this information or dealing with this information. The first one is analyzing the reporting, and this is partly of some of the initiatives that the BIS Innovation Hub is working on. That is basically we have a lot of information on sustainability for corporates and banks that are not standardized. Then we need to get some view of and compare this information and understand how the banks and the corporates are complying with the requirements that we're having. Then tools like natural language processing or artificial intelligence or GenAI could be particularly relevant on this area. The second area is to obtain more information. Here also you can use natural language processing in order to obtain information, for example, on the sentiment analysis for the newspapers or for the markets about for the analysts about sustainability. But also the technology could be used to obtain raw information that could be good in order to understand the effects of climate change. One example is the information came in from satellite information from Earth observation systems. This data is very complex to use because it's very big, non-structured several times, but incorporate a lot of information comparing with administrative statistics from the typical statistical department on climate change, such as publication timelines. You can use almost on time information on climate change, quality issues also, especially for the global south, and also the spatial heterogeneity that you usually do not have in the common statistics. Then this could be an important source of information. The other area is modeling complex scenarios. Most of the scenarios are very non-linear, very complex, have a lot of interrelationship. Then the use of initiatives like digital twins, where basically you replicate an area, you replicate a building, or you replicate a geographical area, and try to simulate different interrelations with climate change scenarios are particularly useful. And in order to do that, you need artificial intelligence, or even some initiatives are beginning to use quantum computing or simulated quantum computing in order to understand all these interrelations. And the last area that I would like to mention, and also I think that there are also some initiatives from the BIS Innovation Hub on this area, is the use of technology in order to develop financial markets. And here, basically, DLT, and that is not distributed layer, could be particularly useful because these are new products, the new markets you need to create in order to obtain funding. And this is particularly relevant for market authorities, that you can use these technologies in order to create these new markets in a less expensive way that could be accessible to small investors because the investment could be very reduced. And what is more important, you can introduce several information for external sources about the compliance of climate change or reporting and so on. Then some initiatives on developing green bonds on DLT and things like that could be also particularly important. And I will stop here with this overview.
No, that's really useful. And actually, maybe, again, this is a nice opportunity to go to CAR, because we're talking about how data can support investors and the private sector with their compliance tools and things like that. So, Carl, do you have anything to add to that, just in terms of maybe what State Street is working on and how you see the private sector kind of using this technology and this data to support their reporting, their compliance with policymakers, and maybe how they're working with policymakers to do this as well?
Yeah, just go off and mute first. Yeah, like it's a lot of the things that Jose's mentioning there are things that will make, I think, a lot of these processes a lot better. You know, in terms of the AI and the language processing and things like that. I mean, like the biggest challenge, I think, for everyone on the kind of asset manager, asset owner side is just the amount of data. How do you sift through it? How do you test for coverage issues? You know, all of that side of things. You know, there's two aspects to it, I think. Like, well, there's two aspects, as Marcus mentioned earlier. You know, there's the risk side of things and the investor confidence. You know, the confidence side, at least from the asset manager side, can be, you know, you can kind of overcome that sort of greenwashing view by bringing in things like regulations such as SFDR and you know, being able to prove that your funds are truly Article 8 or Article 9, all this sort of thing. But that does bring a huge operational burden on asset managers, right? So things like, how do they build these things? Where do they get the data? Where is the coverage of the data? A vendor might be good for equities, but not for small cap equities, not for emerging markets, not for fixed income, that sort of thing. The delays in the data, how recent is, this carbon metric, for a given company that you're invested in. Consistency between the data, obviously you would hope to see between different, say, ESG vendors that you're utilizing to produce a report that, like, your scope 1, 2, and 3 carbon metrics might be similar. We often see that they're not, because it depends on timing between vendors. And then when you get into the more black box kind of stuff like ESG ratings, or climate VAR, these sort of things. I mean, it's a vendor's own technology. So I mean, there's no reason for consistency really, broad brush. And then the other side of it is the transparency into the data as well. So these investors are invested in other funds and their third-party funds and fund structures. How do you bring all that together? So those are the kind of big challenges that we see. So one of those is having that sort of multi-vendor approach, being able to marry all of that data in one place. You can interrogate your big hitter vendors maybe with your more bespoke vendors. So if you're producing reporting, say, for example, again, the SFDR kind of reporting, you have a lot of climate metrics in there, but you also have kind of, social metrics and governance. You may pick one vendor for certain things, maybe someone's strong in climate, but somebody else for your social metrics and so on. So that's part of it. That consistency as well. You can at least compare and contrast vendors and see, get a broad approach. And then, again, on the transparency side, like that idea of being able to bring all of the data in, scale it, aggregate it, normalize all of the different investments that you have all together in one place, and then obviously the automation of the output itself. So, I mean, like huge challenges out there, and that's on the kind of, I suppose, the regulatory side for that sort of the confidence side. And then on the risk side, I mean, obviously the big one for funds is that sort of fiduciary responsibility. In these climate transitions, where are the companies that are going to get absolutely hit? But where are the opportunities? In technology, renewables, that sort of thing. So again, be able to bring those vendors in and to see that kind of simulated P&L, at the top line aggregated up is really useful. But yeah, I mean, I think as time goes on, and we'll probably talk about it again near the end, but the AI has a real opportunity to improve a lot of that data.
Yeah, we'll definitely come into the AI point, and I think the mention of the use of vendors is an interesting one as well, and the different data providers and rating agencies. Maybe we can come back to that. But we started having some audience questions, and we're very fortunate to have Jennifer Willets, who is head of investment sustainability solutions and also leads the sustainability data and research work stream at Franklin Templeton. So I'm going to come to Jen just to kick off some of the audience questions that will be coming through, and that I'll be putting to our speakers. But Jen, maybe I can come to you then to ask your first question, and then we'll go to Zohir Udin's question, which I'll pose to the panelists after that. So Jen, over to you.
Great, thank you. And firstly, thank you to the panelists for what we've heard already. I think a few things resonated quite deeply with me. I think, Carl, a lot of the challenges that you talked through, we really feel at Franklin Templeton as well. We cover pretty much all asset classes, market caps, regions. So your comments on the data availability across those and the difficulty when we have reporting requirements, it really does hit home. And Patrick, what you said about, I think you were getting to the point of basically, don't let the perfect be the enemy of the good, because we hear that all the time, that, okay, there's these metrics, but it doesn't cover my entire investment universe. But if it covers some of it, we know more than we did before. So if there is data available in some areas, often it's going to be those places where it is more material. So I think you're absolutely right that we need to focus in where we do have data and work out what we can do with that information. So really appreciate those comments. And whilst I've said we should do what we can with the data we have, I'm going to bring in a question around another challenge. So from the investor perspective, we find that a lot of the risks, the impacts, the dependencies we have in the sustainability space are through our value chain. And we know that finding data in the value chain is incredibly difficult. I think about a couple of the themes we're trying to think about at the moment. So deforestation risk or water risk. Now, often if I'm thinking about a listed equity portfolio, the main risks to our investee companies are going to come through the supply chain on those issues. And they're also extremely location specific. We know that there are some data sources out there which use, sectoral modeling, or they may use, commodity production, commodity consumption as proxies for trying to work that out. But my question to the panel is, do you think that with advances in technology, using perhaps machine learning, AI, we will get to somewhere where we feel more comfortable assessing those supply chain risks and dependencies? And then I suppose the point two to that is whether you think regulatory disclosure has a role to play, because we know many companies, especially as you move down the market cap chain to the smaller areas, will be reluctant and, understandably so, to disclose their supply chains. So I'd like to just understand what you think the role of technology is and what you think the role of regulatory disclosure is when it comes to supply chains. Thank you.
Thank you, Jen. Who would like to take that first?
I can just maybe give my quick 2 cents. So that's again, Jen, we see the same problems. As a big question from our clients as well on the value chain metrics, and we engage with the vendors as well to talk about this stuff. And I think at this point, regulatory disclosures is probably the only way to get a lot of that data. That said, I think with AI, that screening capability that brings as well, you can start looking at data. You can start looking at company data. Maybe there's a proprietary way to submit data that doesn't involve them releasing it to everyone. That they can start modeling that data and look at supply chain. Let's say if you look at a wide range of companies, take all of their data or load to the database, you should be able to kind of get analytics from that. The same as if you're screening the internet for controversies or revenue involvement or that sort of thing, but being able to much more get into the weeds and computate that huge amount of more data. So I think at the moment disclosure is unfortunately probably the way to get companies to release this, and we're seeing that those kind of challenges even with the EU taxonomy. But yeah, I think down the line the AI is and that massive data handling would be a way to do it.
Yeah, very good. Thank you, Carl. Jose, Marcus, Patrick, any responses from you, Jose?
I'll just say that I agree with the answer here that regulation and AI, they could complement each other. So regulation ensures disclosures, ensures the transparency, and ensures it in a systematic way. And then afterwards, AI is used to collect and collate the data because there's so much data and ensure that we get the trade linkages right.
Just on that as well, you're exactly right, Marcus, and that's something I forgot. AI is only as good as the governance structure that you have set around it, so that's really important.
Yeah. Jose, Patrick, anything to add to that?
We are currently, sorry, Jose, you go first.
You are going to mention symbiosis, then I will let you to. Yeah,
symbiosis. Yeah, I think this is a very good example. Thanks for pointing us to that, Jose. Currently we run a project at the BISIH Hong Kong Center, in which we, with the help of AI, try to put together the Scope 3 emissions of the supply chain, which is a very good fit to the question that we have received to Jen. So this is a very new project, and I'm really looking forward to see the results coming from that. I mean, it is quite difficult to get, in particular, Scope 3 data right. So this is an additional challenge to this project, but this is something that we are currently working on. On the question around how do we combine that actually with other forecasting and nowcasting technology, I think Jose also has pointed out that we currently look at the digital twin technology as one of the very promising technologies when it comes to nowcasting and forecasting. In particular, if we will be able to combine it with AI, because we would need AI to somehow feed the digital twin and to structure the data flowing into the digital twin. And this is something where we currently have a particular focus on. One of the enhancements and taking these kind of ideas and projects to the next level would not only to use the digital twin to look at a specific region and the effects that an extreme weather event for a client could then have on the bank. For example, when we have a flooding in the region, how could damages to housing have implications on the banks? But I think we would also soon start the discussions around what could the digital twin do to analyze the implications that a weather event could actually have on the supply chain of a specific country. So in a company. So for example, in June, we had organized together with the Monetary Authority a hackathon here in Singapore, where we worked on use cases from AI and also from sustainability, from a sustainability perspective. And one of them was a use case from the German central bank in which she actually looked at the level of the River Rhine and how that could actually affect the supply chain of companies using the River Rhine to ship the products from suppliers, which was quite an interesting use case, with quite an amazing result. So I perfectly agree with Jen. It's a very important topic, and we are currently looking into this in all these kind of work streams. Thanks.
Thanks. And Jose,
No, from my side, very little to add. That is basically, or how you mentioned, that is maybe in this, that the supply chain is very important. Technology could be helpful, as they mentioned, in order to obtain more data, to put together the data, but also to increase the traceability. As I mentioned, with DLT, you also can improve the traceability of a product, where they came from, and you can make some codes in order to control of these things. But I would like to add that I agree that the main way to deal with this one is the use of technology, but also the disclosure and the regulation on that. But I would like also to introduce the potential from the private sector initiative, in particular from the banking sector. That is to work on the supply chain. That is basically, banks are very focused on improving, on dealing with green finance on wholesale markets, but also on long-term funding with green bonds and so on, and also focus on this short-term funding through supply chain funding. Then this is an area particularly important because it's the way where you can help your customers to change their business model and to really begin to work to adapt to a new environment and to a new economics business model. Then this is a way where they can improve how the corporates are transforming themselves. Then I think that banks are beginning to realize that this is a good way. They can use technology in order to help them to visualize and so on, but for them, this is a priority because this is one added value that you provide to your customers. Then I think that this is also very important, and it's a value added for your customers, but for you, it's a very important source of information that help you in order to improve your disclosure and how you are compromised with climate change.
Very good, thank you. Thank you so much, Jen, for that question. Really excellent and some great perspective there. So thank you very much for.
Thank you all.
I appreciate it. I'm going to go to the question from Zohe Yudin now from Brunswick. He asks, does the panel see any trade-offs between new technology solutions and climate risk? So for example, looking at the growing carbon footprint of AI and data centers. Marcus, I know you were keen to touch upon this, so I'll go to you first, and then obviously welcome others to come in too. But yeah, Marcus, over to you.
Thanks so much. I think it's a great question, like the other one. so I do in fact see a trade-off between technological solutions and climate risks. So here mentions one trade-off. I haven't thought so much about that, but I'm sure that there's something with data centers and AI using a lot of electricity. But then electricity can also be produced in a renewable way: wind farms, solar panels, nuclear. So I'm not sure. I think it depends a bit on how electricity is produced. One other trade-off between technological solutions and climate risks that I think is perhaps a bit more prominent. That's hasty investments going into untested green technologies. So large hasty investments into technologies that have not been tested by history because they're new business models, and where the technologies perhaps prove to be less profitable than initially expected when the decisions were made. So here I'm talking. I'm taking a historical perspective on financial bubbles, because often financial bubbles occur following the introduction of new technologies and following the introduction of new financial products. So we saw that with railways in the US in the end of the 19th and the beginning of the 20th century. We saw it with the Southeast Asian financial crisis. We saw it with the IT bubble around the turn of the millennium. And we also saw it with innovations in mortgage-backed security markets before the GFC. So in all of these cases, there was some complexities and, you could say, combinations of real economic technological transformation and then the introduction of new financial products, where investors were overly optimistic about the both the non-financial real technologies taking place, and then also the ability of new financial products to handle risks. And then after some shocks realized, the crisis unfolded, losses were incurred. And I do see some parts of this also in green technologies, in sustainable markets. So it's something we also think about in Denmark, that large investments are being made in wind farms in other places that are both illiquid and sometimes also being made in new areas where we don't have accurate historical data on returns and so on. Thanks.
Thank you, Marcus. I think those are excellent points, and I guess. But yeah, I saw you unmuted yourself. Would you like to chip in here?
Yeah, just when Marcus is mentioning that about the new technologies and the perhaps not looking exactly like they did before, that reminded me of another case when you're looking at these technologies, that sometimes a company might look outwardly renewable and great, but that's not the full story. I mean, like, there are examples out there of pretty big energy companies that are building wind farms and on the surface look great, but when you start getting into like the work practices or indeed the biodiversity impacts and things like that, it ends up that they're building those wind farms in disputed land or like destroying biodiversity. So sometimes that top headline is not the full package, which is why it's so important to have that full transparency into a company's into a company's controversies, as well as the trumpeting attributes that they're doing.
Thank you. And Patrick, anything to add to that question?
Yeah, I think I mean, I perfectly understand where the question is coming from, and I do also see the trade-offs. However, if we try to look at it from the other perspective, for me, it's very hard to imagine a situation where we really understand climate risk, how we can mitigate and how we can prepare for the things to come without using the best and newest technology available. Because I think the complexity behind the data finding the data, working with the data, making use of the data in a way that we can visualize something and can really, use something for nowcasting and forecasting is nearly impossible without AI. And hopefully also, as Jose has also touched upon, with quantum in the future, because actually at the moment, we don't really have the tools and capacity to really work with that complexity that comes from climate risk. And to be better prepared and to really cope with the situation, I think we need to make use of these new technologies. This is the best way forward. But I understand where the question is coming from, and I do also see the trade-offs. I just wanted to make sure that there's also another way to look at this, because I just think that we need to make use of everything that we have to cope with that topic.
Yeah. Jose, anything from your side?
Yeah, let me add, I fully agree with what Patrick said, that is, but this is an important topic, and all the publications that we are doing about the use of technology for climate change, we always put this point that sustainability basically should be introduced in all your corporate decisions, and this is one part that should be included. And here basically is a cost-benefit analysis that you have to understand what you need, what are the benefits of doing this one, and what is the cost that you're having. And you have to ask your questions. Really, you need this technology, and really you need this capacity. Maybe this is some more general discussion, not only with sustainability, but maybe the example of Gen AI is a good example. That is basically Gen AI came last year and it changed almost everything. Everyone wants to use Gen AI. And you realize that for some of the problems where you can use Gen AI are problems that can be dealt with small models with not a lot of intensity on resources. And this is the kind of question that you should just make. Okay, this is the problem. Really, I need to train a very big model that will imply out of consumption, or the results could be very similar with a more small model that can be on premises, and I don't need to deal with people. This question should be internalized in how you make things in production. But I agree with Patrick that for some problems, the complexity of the problems imply that you need this consumption of energy, and the benefits are bigger. But maybe for other ones, you can deal with smaller things, and you didn't have to go to the more high fashion technology, or the more in the limit in the technology.
Yeah, no, very, very good. We've been talking about risk a lot today, and we've had a question from Aviran Manikon from the Bank of Mauritius asking, what are the challenges in integrating AI risk-based models into existing risk management frameworks? I think this is quite an interesting question. Who would like to take this first? Patrick. Oh, sorry, who was ready there?
I can give a perspective from the asset manager, asset owner side of things.
You do.
It's just so I mean, I guess the risk management framework for is quite defined for an asset manager, asset owner. In these fixes, they're looking at various metrics, right? They're looking at carbon output, transition risk. The obvious ones are exclusionary factors, revenue involvement, all of this kind of stuff. I suppose the good news answer here is it probably can be integrated quite easily, at least at the asset manager, asset owner side, because it's coming downstream from the ESG vendors that they're using. So if the vendors can integrate that technology, it'll flow pretty much automatically. So like if you take, for example, your carbon scope 3, as Patrick mentioned earlier, pretty difficult metric to bring. Now, our vendors produce that at the moment, and it's added into regulatory reports and set on targets and all of that. But if AI was used to, say, scan satellite images, as Jose mentioned earlier, and get a much more accurate and up-to-date figure for the output from a company, the vendors would then send that out on the reporting and the analytics. And so the AI would be integrated sort of downstream a little bit, and the asset manager, asset owner would benefit from those technologies relatively seamlessly, I'd say.
Yeah, good. Anyone else want to add to that question?
Maybe a very general point, which is not directly related to the integration of AI risk models into the existing frameworks, but on the general use with AI tools. So what we see, and this also applies to the integration of AI risk-based models into the current frameworks that we have, is that very often the biggest challenge that we have is that people working in these areas do understand what is actually done by the AI. So most of the people working in risk management frameworks, they actually understand what this risk management framework is about. And this is very often not the case when it comes to AI, because how currently innovation is structured in most financial institutions, central banks, is that we create hubs, like innovation hubs or data hubs or whatever. And there we have a couple of very intelligent people doing very interesting stuff, and they try to show the art of what is possible with the technology, but they have never worked in banking supervision before. And this is really critical, because then we have a very cool tool that nobody really uses, just because the people that work in banking supervision in their day-to-day business, they are not aware what are the underlying assumptions that the AI is actually working with. So for creating AI-related tools that really work and are used, and this is the same for the integration of AI-based risk models into the existing management frameworks, we have to make sure that interdisciplinary teams actually work on the generation of on the creation of these tools to really make a difference and to really make those tools to be used in practice. So this is, I think, the major challenge that we see whenever we talk to banks.
Let me add one point to what Patrick said. That is perfectly right. That is, when we need to connect these two words. That is, when you look at risk analysis, you realize, for example, that most of the ratings company are providing ratings for credit and are providing ratings for ESG or for climate risk, and are separated. One of the reasons of doing that is that basically what we need, that is, you can analyze what is the rating or what is the behavior of one company in managing climate change, but what is more complicated is how to translate this one in financial losses, and this is when we need this link between the people from the banking sector, from the risk modeling, and the people from AI and from climate change, and this connection is not very easy to do, and this is because we have like separate words. That is, one thing is, okay, how well are you dealing with all the risks, but what this really imply, and to create these scenarios, to translate this into financial losses, into monetary risk, is where is the biggest difficulty, and is where we need this merge of these two things.
Yeah, thank you, Jose. I think that's a really excellent point. We've had another question from the audience from Steve Wilkinson, who is asking, governments are also managing risk in light of climate change. So how much effort is going into working with governments to assess and manage risk exposure? Marcus, you're interested in answering this, so I'll come to you first.
Yeah, also great question. I think we're seeing a lot of good questions today here. Steve here is absolutely right that governments, they play crucial roles in enabling banks, companies, central banks, enabling these agents to be able to manage their climate-related risks. So we have been talking a lot about technological uncertainty, technological risks today. But another dimension of uncertainty and risk, that's policy uncertainty. So policy uncertainty, and by that I mean a climate policy uncertainty. So climate policy uncertainty means that companies and banks don't know their future framework conditions because governments don't commit to these. So banks and companies, they don't know the future costs associated with carbon emissions. And global policy uncertainty also means that we don't know the degree of global climate action that will be taken in the future. Hence, we don't know the future degree of climate change. So what we need governments to do is to commit to pre-announced plans for carbon taxation. We need this at a national level, so that banks and companies at the national level know the future costs of carbon emissions, the future carbon price, and we need it at a global level so that we have an idea about the expected future degree of climate change. Now, the nice part about pre-announced plans for carbon taxation is that this also incentivizes investments into carbon abating technologies at the time of the announcement. So there's an announcement effect before the taxation actually takes place. But just to get an idea about the challenges here, so I started out talking about the cooperation that we at the Danish Central Bank have with an expert group under the Danish Ministry of Finance on climate change scenarios, or sorry, green transition scenarios for the Danish economy. So a challenge here is that we need to make assumptions about the future climate policy of Denmark. So we are making various scenarios there. So of course, the more clear, the more transparent Danish policymakers are about future climate policies, the better scenarios we can build.
Yeah, no, I think that's a really excellent point. Is there anything that the other panelists would like to add to this, or addressing that question?
Yeah, this is not completely related with technology, but here that is the role of government. As Marcus mentioned, that is one area is to increase this carbon credit markets. But maybe a big debate is what is the market disciplines for governments, on what they are doing. And basically here you highlight two different trends, and maybe technology could play a role in these different markets. One is that you have the green bonds, that basically you have a more standardized, that's similar what the corporates are doing, and basically you compromise that some resources are going for some green project, but basically you are not analyzing the complete behavior of the government compromise with the green finance. Basically you are saying, okay, I obtain these funds and I compromise that these funds, or at least this amount of funds, will be compromised to some project that will be related with climate change. This is the area where most of the governments are issuing green bonds are entering, because it's comparable with what the corporates are doing, and they are international standards, and it is more common. But the other trends that I think that only some countries like Chile and Uruguay are doing something on this area is to issue sustainable linked bonds. That basically you compromise with some metrics, with some KPI that you need to comply as a country related with climate change. Maybe to reduce the emission, and this could be checked with satellites about the emission of this country, or maybe it's with gender target, or whatever compromise that can be checked, can be as a country. And in order to check this one and be transparent, you can use the technology. If you are not complying with this compromise, basically you need to pay more to investors. Then this have a higher discipline, but has lower liquidity because it's not so standardized and it's less common. Then this debate of what is the best way to discipline the governments, I think it's a fair debate, and it's an open debate. I think that the World Bank has produced some reports on this area. But this is one important area on knowing how the governments really are transparent about their compromise with climate change.
Yeah, no, thank you, Jose. We're running out of time, and I want to allow for final remarks. And I had a final question, which was, as we've been talking about data a lot, the role that AI will play in structuring data and analyze and generating emission reports, which I think also ties in a bit to our conversations earlier with risk analysis and supply chain management and all of those kind of things. Jose, as I'm on you, maybe I'll turn to you first for final remarks, and if you'd like to touch upon that question, that would be excellent. Thank you.
No, that is not very much more to add. I think that as I mentioned, that is the climate change is a new risk, it's a new data. Then we need more granular information. The report that you are producing is great. It's very informative. I really encourage everyone to read this one. We have very recently also some report for the NGFS about granular data that is also very interesting, and using technologies is mentioned also there. Then this is an area where really we have to push everyone, and the technology could play a great role on that. Then thanks a lot for organizing this event and for providing information on this one.
Thank you, Jose, and thank you for your contribution to the journal as well. Carl, I'll go to you next just for final remarks. Thank you.
Yeah, I mean, I guess just the main advantage of that increased level of technology and AI will be efficiency in those analytics that we need in terms of scanning for controversies, more accurate carbon output ratings, more accurate revenue involvement, just all of these things. And more importantly, I suppose, more almost real-time metrics rather than maybe 2 years lag and things like that. So, I think definitely a bright future. But to Patrick and Marcus's point earlier, I think the AI side of things has to be transparent as well. You need that governance, you need that transparency to make it effective. But yeah, that's it. But thank you very much. This has been very, very interesting.
Yeah, thank you so much for joining us. Patrick, over to you for final remarks. Thank you.
Thanks a lot, Emma. I think the one of the most important things that we can have like a takeaway from today, I think, is that we have to start and really work on this topic, because it's a massive and complex development that we are facing. And we should stop waiting for the perfect data and technology to come along and just start with what we actually have, because we have to get started and work on this. And the more discussions, and that's why I really appreciate the invite to this panel, the more discussions that we have around this topic, the better it is, because we are all in this together, and we really have to get this right. So thank you very much for this very interesting panel.
Thank you, Patrick, and to you also, thank you for your contribution to the journal. Marcus, final remarks from you.
Right. So thanks a lot. I think we've had a great discussion here today. One final remark from me, that would be that there's a whole other dimension to this to data uncertainty that we haven't talked so much about, and that's the interaction between different types of risk with each other. So just to make an example, so this is an example on interactions between green energy security risks and then geopolitics on the other hand. When Europe transitioned from having an internal coal-based electricity supply to having to relying on Russian natural gas, that initially that made Europe cleaner, less reliant on coal, more reliant on cleaner natural gas. But then once geopolitical risks with tensions with Russia started occurring, then suddenly this green transition from coal towards natural gas actually became a geopolitical liability. So that's an example of what within energy economics is called the energy trilemma, that you want to trade three aspects of cost, efficiency, security of supply, and clean technologies, non-polluting technologies. And I think that there are some issues here we don't quite understand yet. So thanks a lot.
No, thank you so much, Marcus, and excellent point. And thank you so much to all my panelists for joining today. A really interesting conversation. To our audience, the journal should now be in your inbox, so please do read that. Please do read the articles that will also be available on our website. Thank you so much again for joining me. Thank you for this really fascinating conversation, and I hope we can continue this over the coming months. I'm sure we will. This is something that will only grow and increase in interest, I think. And yes, thank you ever so much, everyone, for joining.
Thank
you.